Hello and welcome to the stock specific class for Thursday, May the 20th. We did get a bullish reversal day yesterday when we opened lower and then reversed back up. Today we've been moving a little bit higher, but I want to show you on the chart here in just a second why I think it's possible this could be a little bit of a sucker's rally, and I'm being very cautious not to jump in too heavy right here, and I'll kind of outline that when we get to the chart. As far as the direction alerts, you're seeing a major drop in momentum. Momentum is down into the bearish range right here. You see that breadth has moved down a little bit. It's in that kind of trending area, but sentiment is still pretty high. So what that's telling me is that the trading crowd is still bullish. They're not too worried about the selling, but clearly the momentum is dropped pretty dramatically. So the danger here is that the trading crowd is just not worried about the selling, and that was evident yesterday when we opened lower. Immediately started to rally back up, had that bullish reversal. Everyone's just in that buy the dip mentality. Anytime the market's down, they're just going out and buying, and it's pushing it back up. Now, that works for a while until it doesn't, and when it doesn't, that's when you get these big kind of crashes that happen, because that's when the panic kicks in. The panic selling starts to kick in. So I'm not saying that we're going to see panic selling anytime soon, but we're building a condition right now where it could take place. So that's what we want to pay attention to. There's kind of a disconnect going on. That momentum is dropping, but yet the sentiment is still a little too high. It's not dropping on with it. All right, let's go over to the chart here. Well, real quickly on the buy-sell ratios, you can see they've started to cross a little bit. You've got the sells start to increase versus the buys. So there is that kind of subtle shift taking place. There's more stocks that are starting to go to sell signals than buy signals. Sentiment is dropping. We're not quite yet down to where you'd be more bullish on that, but it could still have a little bit further drop there. All right, let's go into the watch list here, and let me kind of outline what I think is happening. I've talked about the last couple updates that it's been a little unclear where the next direction would be in the market, because you have impulsive up right here, you had impulsive down, and then we had impulsive up. So we're not getting that impulsive corrective alternation that we normally see within trends, uptrends and downtrends. So, and so what I'm worried about here is that this move down right here was wave A. Typically, again, I've got a full training on ABC patterns. If you go into YouTube and type in Traders Pro, you'll get a list of there's different trainings that I've gone over in the past, and one of those was on ABC patterns. On these pullbacks, they kind of, stocks will tend to pull back in kind of three waves. They have the initial sell-off, you get a bounce, or what we call a sucker's rally. This is where the dip buyers get too impatient. They start buying the dip too quickly. It fades, and then you get kind of that flush out move that creates the bottom or the end of the correction. So that's wave A, wave B, wave C. Now, one thing I talk about a lot of times is because that's a sucker's rally in wave B, it can tend to be a little bit more choppy. In other words, usually that first sell-off is sharp. It's usually more impulsive. And then in that wave B, it can kind of be an opposite ABC pattern, kind of choppier sideways, wave B. And then wave C tends to be impulsive, where it drops down. That's the flush out selling. and then the trend continues. And sometimes you can't see it on a daily chart, but if you were to go into an intraday chart, a lot of times you can see that back and forth in that B wave, in that suckers rally. Well, that's kind of what I think is going on right here. I think that that this rally off the bottom right here was wave A of that wave B, so it's going to be a 3-wave move creating that wave B. This drop right here was wave B of B, and this rally right now I think is wave C of that larger wave B. Hopefully that makes a little bit of sense there. And then after that's done, we should get a flush out move down for wave C before I think the trend will be a little bit healthier moving up. You can see it kind of happening right here. You had the initial sell-off right here. You had this kind of choppy back and forth, kind of wave A, wave B, and then you get that drop for wave C, and then the trend continues. Your wave B was really quick right there. Wave A, wave B, wave C. Now, does it have to do that? I mean, another way to look at it, you could say, well, Jerry, isn't this wave A, wave B, wave C, and we're going higher? That's definitely possible. The tricky part is the concept is, that the stocks will tend to alternate between impulsive and corrective. So you get impulsive, corrective tends to be more choppy, more sideways, impulsive, corrective. That's the concept. Being able to read exactly what corrective is not always the clearest. Here was a move where that was the correction right here, but it looked like an impulsive move down. There's a quick drop and then took off again. There wasn't that back and forth. I say this all the time, though. If there was a pattern that worked every time, that would always work, we'd always use it, and we'd never be wrong. So you have to realize that that the market gives you clues, but it doesn't give you exactness. We want exactness, and that's why people go from software program to software program and guru to guru. They're trying to find the person that's always right, never wrong, and so they don't ever have to feel that pain of a losing trade. I'm telling you, I'm going to save you a lot of money right here in your trading career. Just realize it's never going to happen, and just focus on embracing the uncertainty, embracing that things aren't going to be exact, and then focusing on just trying to read the probabilities. Again, our job as trend traders is just trying to read as best we can what those professional traders are doing. And sometimes it's going to be really clear in the pattern, in the chart pattern, what they're doing, and we're going to feel like geniuses that as we follow along and it goes exactly how we thought it would go. At other times, it can be a little bit murky, and I would say that we're in a kind of a little bit of a murky area the last couple weeks. Now, what will help us here is a couple things. If I'm right, then and that's wave A, and we're kind of in the process of forming this wave B, wave A, wave B, wave C of wave B. Then this rally up here, this rally should be on very light volume, and it should be a little bit more sluggish. In fact, it wouldn't be surprising if we have another update tomorrow, but it fades a little bit into the close or something like that. Now the volume today, although the move is pretty big, the volume is very light. We've got 2 hours ago before the market closes, and we're not even at half the volume we were at yesterday. We'll be lucky to hit the volume that we had earlier in the week. So it's kind of rallying on that light volume. And you'd probably get some sort of a bearish reversal candle. You might, you don't always have to get that, but you'll usually some sort of bearish reversal candle that might signal that you have another move down. But that's kind of what I'm looking at here. If we look at the Dow, same thing. NASDAQ is already looks like, it's already gone beyond this area right here, but still doing so on very light volume. And then the Russell's just not even participating today. And I think that's kind of key because, the small caps are always something we look at to read the strength of particularly a bullish trend, because that tells you where the risk appetite is of those professional traders. If the professional traders are very confident that the market's going to rally, they like to get into those small cap stocks that are usually a lower price and usually are in their pretty rapid growth phases, so that they can make a much bigger percentage gain on those. Now, when they're a little bit more cautious, then they tend to stick to the bigger companies that aren't going to go under, that can still go higher. You know, the Procter and Gamble's, where people are still going to buy the products no matter what economic conditions we're in. It's not going to disappear overnight. They tend to go into the safety of those larger companies. So the way I'm reading this today is that the market's bouncing back, but there's not a big risk appetite showing up here, with the Russell 2000 being a little bit sluggish here. So that would cause me to be a little bit cautious that there might just be this rotation into some of the safer companies, which tends to happen at a market top. That those companies tend to be the last ones to rally within a larger uptrend. Okay. And again, we're still on the Russell, still looking at this potential bearish head and shoulders pattern right here. We keep kind of hugging the neckline right there. Haven't broken below that neckline yet, but that might be coming here pretty soon. So bottom line, we want to be a little bit cautious with today's a stock specific class. We're going to go over some stocks, but we want to keep in mind those conditions. And we've had these conditions for the last little bit, so we've been a little bit more cautious anyway with some of the stocks we've been looking at. We don't want to get too aggressive in this type of market environment, at least not yet, not until we see a little bit more strength in the trend. VIX, though, did move. Actually, let me go down the list here, because gold, we talked about. I'm not going to do a full market update here, but gold is continuing to move higher. And what we're seeing with gold is that with Bitcoin crashing and all the cryptocurrencies crashing yesterday, a lot of traders are going back into gold. They had kind of gone into those cryptocurrencies as kind of like they would go into gold as kind of a safety type trade with inflation coming, and now they're starting to rotate more into gold. They're not ditching crypto completely, but they're kind of it looks like they're making a push into gold. And like I said, with commodities, particularly gold and silver, when they appear overbought, you look at this and say, well, why would I want to buy into this right now? It's already gone up so much. Usually when these take off, they tend to stay overbought for a while. So this could. I'm not saying it has to. It could be have a drop or two along the way, but this looks like it could continue to move higher in the near term and become even more overbought. So you don't have to. In fact, that's usually what a lot of those commodity traders will do is wait. Instead of trying to buy at the bottom, they'll wait until they start to see it clearly moving, and then they jump in and ride that last little bit. Let's go down to the VIX. So here, VIX, take the volume bars off. The VIX spiked up on that reversal yesterday, but it's come back down again. But again, we're starting to see these little spikes taking place, and those are little kind of warning signs that something bigger could be coming. So you see back here, you see that you start to get these little spikes, and then you get the real big spike that came up that happened earlier this year. So we'll keep an eye on that. All right, let's get into some specific stocks here. Some of these I've gone over before. They're still in good areas. One is actually, it's already gone to a buy signal for a few days now, but I know the transportation stocks, I'm going to go into the buys because this is one I signaled. I think it might have been last week. It was ANTE, Internet Technology. I'll switch this to signals here. And what I was pointing out on this one was that there was that potential that we were forming kind of that inverse head and shoulders pattern, that upside down head and shoulders pattern. And what I had mentioned was you could wait for it to go back to the buy signal as a signal to get in, which it did, or you could wait for it to break out of the neckline there. Now it's kind of paused a little bit today, right at the neckline, but this would be if you missed a previous entry point, this is a potential additional entry point, because you could get in on a breakout of that neckline of a potential inverse head and shoulders pattern. Again, the rule of thumb is if it breaks out, it will tend to move up about the same distance of the neckline to the base of the head. You take that distance and project it upward. You've got some resistance back in here that's right around that $5 area. Now, it ultimately should keep going higher, reach new highs and things like that. But that's just a minimum expectation with head and shoulders patterns, and so it can help you in some of the trade management decisions you need to make. So anyway, I thought I'd point that one out. Let's go into industrial products. And I'll go into the hold section on this one. I like this CLIR, clear sign combustion. Now this recently had a sell signal, but I like the larger context here. Let me double check something. Yeah, I always try to, sometimes I forget to check to make sure they're not an over-the-counter or OTC, make sure they're actually trading on an index or on an exchange. This is trading on the NASDAQ, so we're good here. But again, there's a larger uptrend right here. I talked about that ABC pattern on the pullback. That initial sell-off right here looks like wave A. And this is very similar to what was trying to explain to you on the indexes, the SPY and the DIA. Notice how in this wave B, you had that initial move up, it came down, move up. So you had this smaller A, B, C for wave B. And then it looks like this is that final move down for wave C, and it looks like it's starting to maybe turn the corner. Again, you'd want to wait for it to go back to that buy signal. If it came back below here, that's usually a good area to stop out, because it means that's not an ABC, or it might not be an ABC. Maybe you're in a full-blown downtrend, because sometimes downtrends will look like ABCs. You'll have the initial move down, wave A, wave B, wave C. And remember, stair step up, stair step down. Sometimes it'll look like the correction is done. It looks like an ABC, and then it goes down. You're in a downtrend. You're not done going down. So that's, if you understand that you can use that after it looks like an ABC, you can use that low. Well, first of all, wait for it to start moving back up, but you can use this low as a stop point, because if it drops below there, then that wasn't an ABC. You could be in that downtrend. You'd want to be able to stop out quickly, or recognize that pretty quickly. So anyway, that's how you could kind of look at this particular chart. And let's see how far it is. It's probably a little ways from get to the buy. Not too far. It's kind of halfway in the hold range. Not too far from moving into that buy range. And then another one in industrial products, kind of a familiar name, is Alcoa. AA is the ticker symbol. Now this one needs confirmation, because it could be in a much deeper downtrend, but it does look like potentially that was wave A, wave B, wave C. Again, very often in an ABC pattern, wave A and wave C will tend to be about the same length. Keyword there is about. They don't have to be exactly the same length, but the wave C is usually about the same length as wave A. That's kind of what we have right here. If that's wave A and this is wave C, maybe wave C is a little bit longer, but it's right at that point where it looks like it could be done. But we've had 2 down days, so it hasn't shown me anything about going up yet, starting to move back up yet. So I'd want to wait for that confirmation. And the easy one would be to wait for it to go back to a buy signal. That way, if it dropped dramatically further than this, I mean, right here is a key spot because you've got resistance here, support here, and you want that to be support right now. If it significantly breaks below that, I'd probably assume that this is in a much bigger downward move. I'd probably stay away from it. But again, it's potential pattern here. You'd want that confirmation. Hopefully, go back to a buy signal from here. But I like that overall trend. You can see here's kind of that wave A, wave B, wave C. It's kind of a similar thing on that wave C. It kind of dropped down sharply, and then it kind of rebounded back up. You're kind of expecting that same thing to happen here. By the way, if we went back to CLIR, that's another thing that's, looks like this wave C. If this is wave C, it looks like, wave A and wave C are about the same length or so. All right, let's do one more. Let's go into retail. Actually, we did talk about plug on Tuesday. I pointed out that it looks like it might be possibly reversing right here. I said key would be to go to a higher high. These were lower highs right here on the way down, lower highs and lower lows. And it's right up in that area but if it needs a little bit more confirmation, but if it can break out to a higher high, doesn't always mean it's in the reversible. That'd be the first sign of a potential trend reversal, is going to a higher high after not having a higher high all the way down this move. You could wait to see if it goes to a higher high and wait for the next pullback to see if it gives you a higher low. Just depends on how much confirmation you'd want to be looking for there. All right, let's one last one I'm going to do is under retail. I brought this one up before. American Eagle Outfitters, AEO. I think I brought this one up over here where it looked like wave A, wave B, wave C. It's still, again, that's kind of the ideal, is you get the initial sell-off for wave A, bounce for wave B, and then wave C. But again, that's not how every pullback looks. What I tend to look for is that pullback looking more choppy or sideways. So I may not have a real clear wave A, wave B, wave C right here, but the behavior is more sideways and choppy. That's corrective. And the previous move was impulsive up. Now you're getting corrective. It should lead to impulsive up. Typically, when stocks reverse their trend, they tend to be more of a pointy type top. So they tend to impulsive up, impulsive down. They don't usually move up, have impulsive up, and then move sideways and then start dropping. That can happen, but it doesn't usually happen. So the fact that this is still a little bit more sideways, I know we're down a little bit. We've gone to a little bit of a sell signal here. And by the way, this would need confirmation anyway. So if it does continue to drop, no problem. We're not in it. I'm not saying to get in it here. I'm just saying that this looks corrective right now. And if it holds in this area here, it could still be a correction for another move higher. You could wait for it to go back to a buy signal, which is probably going to be up in this area here. You could even wait for it to break out. If it can break out, you want to buy that breakout because it's probably taking off. Like I said, if it keeps dropping, who cares? Move it off your watch list and move on to something else. But potentially here, that could be near the end of a correction there on that. And it's been in a sector that's been performing pretty well. The retail sector's been up there in that top top of the list here for a while. So, all right. So we'll kind of finish with those. Now, the training today is going to, we're continuing on with our candlestick analysis. And we're going to go over a couple more reversal candles, some of my favorites to trade. There's actually 4 of them, but I'm going to point out the ones that you're more likely to see. Some of these don't show up very often. Let's pull this up here. And I know some of these have some weird names, it seems, especially if you're seeing them for the first time. And I'll repeat what I've said throughout all these trainings on candlesticks. I don't care if you know the names of them. What I want you to know is what they look like and what they signal. Does it signal that the stock is more likely to go up, or signal that the stock is more likely to go down? It doesn't matter if you get the name right if you can understand the price action. So now these are all important in context. The hanging man and the hammer are formations that they have the body up here. You can have a little bit of a move above, but typically you'd like to see it very small or none at all. But it's rare to get no shadow or no. They call these wicks too. This is the candle right here, and then these are the wicks. They're also called shadows. Trying to think of other names, but anyway, so in this case right here, you've got a long lower wick or shadow, and you've got the body is up here, and whether it's a hammer or a hanging man depends on the context, depends on where this formation is showing up within the trend. Is it showing up at the end of an uptrend, or is it showing up at the end of a downtrend? Okay, the hammer is the one that's the bullish version of this, so you'd want to see it show up at the end of a downward move. The hanging man is a rare. You don't see very many hanging mans out there, and even when you do find them, they're not as reliable. I don't trade a lot of hanging man formations, but these show up at the end of a upward move, and they signal a bearish reversal. I think context is always key with these formations. Just seeing the formation it is not going to signal a strong move. If the stock is moving sideways and you get a hammer formation for the day, I don't trust that hammer formation. It really means nothing to me because it's not signaling a potential reversal. Same thing with the hanging man. Now, what's the context of these? Let's take a look at. We'll look at some live examples of these too, but here's what you'd want to see for a hammer. See the stock, you want to see the stock declining. Now, it could be a few days. The longer the decline, the stronger the reversal when you get that hammer. If it's dropped just a couple days, sometimes you'll see where it dropped, just the hammer was the drop. It dropped, the stock was moving up, it dropped down and formed a hammer formation. Those aren't as reliable. They have a tendency to fail a lot more. You'd want to have a few days down before it, if possible. Now, I'm not saying you couldn't bounce off of that. You have a one move down with a hammer. It could bounce a day or so. You could open higher the next day, but they have a tendency to fail a lot of times. The stronger formations when it's been declining for a little while, then you get the hammer. It looks like Thor's hammer. You're watching the Thor movies, the Marvel movies. And that's a bullish reversal. Now, sometimes what I'd like to see off of it as confirmation is I'd like to see the stock immediately open up the next day. There are times where it can open within the shadow down here. It could actually open a little bit lower and still end up moving higher, but those are a little bit less reliable. I don't trust those ones as much. And whenever I see it open down into here, I get a little bit concerned that maybe that reversal isn't going to happen. Another thing you'd like to see, it's not always the most critical, but it's something you always want to see with trades for confirmation is volume. Doesn't have to be huge volume, although a lot of these do create huge volume. Because what's happening here is what's happening is the stock has been selling off, selling off, selling off. It opens lower right here, and then sells off all the way down here. Usually this is a capitulation where it looks like everyone's panicking, and then the buyers, the smart money comes in, and the buyers push it back up. And not only do they push it back up, but it's a stronger hammer if they can actually close it higher than where it opened, which happened in this case. So here's where it opened, dropped all the way down here, pushed it all the way back up to close it higher. Technically, it doesn't have to close higher. It could have opened up here, sold off all the way down here, come all the way up and closed a little bit lower. That could have been a black or red candle, depending on what color you use for down. But getting a higher close is definitely a stronger one. And so again, there's different degrees of these as well. Could you still trade that? I'd still trade that even if it had a black a lower close. I might wait the next day to make sure it's opening higher as confirmation, or something like that. But that often signals a bullish reversal. Now, another key important thing and I keep mentioning this with all these candle formations, is they're very short-term indicators, meaning all this is telling me is that stock should move up the next day or maybe the next couple days. It's not saying it's going to start a new uptrend. However, if this forms in another context, it can signal a bigger move. So if you had this big uptrend, you get wave A, wave B, and then you're in wave C and you're dropping, and at the end of that wave C, you get a hammer. That hammer could tell me that this correction is done, and this stock is about to continue that uptrend, probably make a pretty big move. I can draw a larger expectation out of that context. Okay, but all this is saying is all this is signaling is this thing could move up in the next day or two off of that reversal. Okay. And by the way, you can form, all these candlestick formations don't show up. Well, they do show up all the time, but they don't show up necessarily every day. Well, I shouldn't say that. There's always some stock that's kind of forming something, but you could form a very short-term trading technique. It need to be very short-term, but you can set up a very short-term trading technique off of just trading candlestick formations. And you can do pretty well as long as your trade management, money management was sound and all that. But this is something I think you just have to learn to really be successful in the markets, because this is what we're doing. This is reading price action. We're reading what's happening with those professional traders. There's panic selling. I don't know who bought, but somebody that can move the market bought this thing and pushed it back up. That's a signal that smart money may be jumping in right there, and I might want to jump along with them. Now, the opposite of this would be the hanging man, which tends to show up at the end of an upward move. And it's called a hanging man because it looks like a man hanging from the gallows. But the context is you have an upward trend here. And so what's going on right here is the stock opened higher, and I'd like to see I'd like to see this be a black body, or red if you're using red for a down day, meaning it closed lower than where it opened. But here it gapped up, so it was moving higher here. It gapped up here at the open. It sold off, so sellers pushed it back down. Buyers pushed it back up, but were unable to close it higher. They were able to push it back up, but were unable to close it higher. You say, well, why is that bearish? Buyers pushed it back up. Well, because this is a reflective of an exhaustive move, meaning buyers were pushing it back. Well, first of all, why is it selling off so much? If your trend is real strong, why did it sell off? You don't need to know why, but there's a reason why it sold off right there. And it could be the smart money was getting. Typically, it's a view that the smart money is getting out, because they're usually the ones that are done buying, done pushing it. They're starting to get out. And then usually it's the dumb money that's pushing it back up because they're buying the dip, right? It dipped and they're buying it. And they're unable, though, to close it higher. Even if they do close it higher, the fact that it dropped so far, it's showing just that. It's showing just an exhaustive move. Now, those are subtle, but that's not the strongest reversal. I mean, I've seen stocks that are showing. In fact, the reason why I don't trade hanging man formations alone is because sometimes these show up as a warning that the trend is about to reverse. Meaning, sometimes you'll see these hanging man formations not at the very top of the trend, but near the top of the trend. So maybe this thing does rebound and go higher, and maybe it has a couple more of these before finally having that drop. But the bottom line is, if you start seeing that formation after you've had a good run in the stock, it could be a signal to tighten your stop. It could be a signal to take some profits off the table. It doesn't mean you have to just get out completely, but it could be a little bit of a warning sign that the buying power or buying momentum is getting exhausted. Okay, and if you are going to trade that, you'd probably want to wait the next day to make sure that it's starting the reversal, it's starting to move back down. All right, I'm going over the definitions of these, and we're going to look at the live charts to recognize them. The next two are the inverted hammer and the shooting star. Let me go back. So out of these two, the strongest trading one is the hammer, and that's the bullish version of this. Okay. The hanging man it's a reversal, and it's the same formation. These are both the same. Remember, they have the long lower tail or shadow. The hanging man isn't as strong as the hammer. The hammer is the stronger one. So if I'm trying to look for bullish reversals, I'm looking for hammers. Okay. Out of these next two, again, the formation is the same. It just depends on the context. The inverted hammer and the shooting star, it just depends on where they show up. One's going to show up at the bottom of the trend. One's going to show up at the top of the trend. They have the long upper shadow or wick, and then the body is down at the bottom. Out of these, the shooting star you'll see these all the time. And these are the best bearish. You want a nice, strong bearish reversal to trade. You want to get good at recognizing shooting stars. And if you do see a shooting star, you want to probably look to get out of your trade because it's probably going to drop a little bit off of that. The inverted hammer is much like the hanging man. It can be a reflection. It can be an indication of selling pressure alleviating, but that stock could still drop a little bit further off of an inverted hammer. It's not as strong a bullish reversal formation. So let's look at the context here. So an inverted hammer is like an upside down hanging man. Okay, it shows up at the bottom of a trend. And this is where you have the stock opening lower right here. Buyers pushed it up. Sellers pushed it back down. But it managed, the strong inverted hammer is it manages to close higher than where it opened. But it could still be lower. You're just looking for that type of formation at the bottom of a move. What this is showing you is that buyers are starting to show some life right here. The sellers drove it down. Buyers pushed it up. And again, the assumption here is that these are the institutional traders now that are looking to get in. They're starting to buy. Kind of the dumb money is still selling because they're trying to get out, or they're seeing it as another opportunity to sell because they've lost so much money here. It's bouncing, and this is another chance to sell and get out. They're selling, and it's pushed the price back down. This could be an early warning or early sign of buying interest. Again, sometimes the stocks start to move lower off of these still. That could be an early sign that maybe buyers are starting to come back in. When you start seeing those inverted hammers. And then a shooting star is like an upside down hammer. You have the run up stock, typically it'll gap up, start to run up. It looks like another strong day, and then it fades into the close, and it's really strong when it can close lower than where it opens. Now, sometimes you might have heard me call this type of, I used to call this type of formation black candles based on the charting service I would use. But anytime you see a stock close lower than where it opened, but higher than the day before. So if I was looking at this on just, whether that's the XYZ stock, this would, let's say this closed here at $50. It opened up here at $55, but closed right here at $53. It closed lower than where it opened, right? But it's still going to show that this stock was up $3 from the day before. So if all you're looking at is, hey, that stock, why was that stock weak today? It was up $3. That's good. Well, that's not what's showing up in the price action. The price action is saying that's not good. That's a weak close based on what it did that day. It's the momentum has shifted. And you better recognize that, because if all you're focused on is whether it's up or down for the day, you're going to lose a lot of money, because you're not going to be able to read what's going on below the surface. Very often these will at least pull back a little bit off of that move. Doesn't have to pull back a lot. And remember, these are all just very short-term signals. But you'll see a lot of these at the top trends. You'll see a lot of them, a lot of shooting stars out there. All right, let's take a look at some examples of these. Hold on here. And I just kind of went through some of the Dow stocks just so that you can kind of practice by, stocks you're already familiar with. Let's start with the hammer and the hanging man. That was the first set that we learned. Remember, the hammer is the bullish reversal, and it's the stronger bullish reversal. The inverted hammer and the shooting star are the shooting star is the stronger bearish reversal on that one. So, all right, let's look at on the hammer formation. Let's pull up Home Depot. And let's go back here in March. You can see there's a hammer. Now, ideally, you'd like to see the hammer on its own down here below everything. That's a really strong one. But here you actually have, not only do you have a hammer formation, but remember in one of the previous trainings, this is also an inside day where the body closed inside. You had the downward move. Remember the harami? We went over the harami. So it had kind of both of those things going on here. By the way, here's a little bit of kind of a possible hanging man. But see, it still ended up moving higher, but that was maybe a little bit of a warning sign for this little pullback to come. Now, this is maybe a little bit of a hammer. I would have liked to have seen that. Actually a really distinct. The tail should be a lot longer than the body. You'd like to see a little bit more compact body on that. I mean, that's still a bullish reversal price action because it opened lower. Here's where it opened. It traded down here. It closed here. It closed higher for the day, but lower than where it closed the day before. A lot of these did this yesterday. And I jumped into a few trades just trading them overnight that they bounce and they bounce. Made some it's like easy money overnight when you see a price action like that, especially when you see it all over the place. But it's not quite a hammer formation, but that is a bullish reversal formation there that formed there. All right, let's look at Coca-Cola. And you can see a real clear hammer yesterday on Coca-Cola. Again, you want to see a drop. Ideally, you'd like to see higher volume, and you can see the volume was higher than average. Doesn't have to be huge volume, but at least average volume or above average volume. You don't want it to be real light volume, because that's telling you that's not very significant. There weren't a ton of buyers coming in real strong right there. It might have just been a few buyers and just a lack of selling interest that caused the reversal. You like to see higher volume because it indicates on the drop, it indicates heavy selling, and then it obviously it takes a lot of buying pressure to push the price back up. It usually you're going to have higher buying coming in. So the overall day, it should be higher volume. It should be a big volume day when you get, at least if the reversal is pretty strong. So I do think that's pretty significant on those formations. You get higher than average volume. JP Morgan, I think, had one yesterday, although this one's not really. See, that was a one-day drop right here, so that's not as strong a reversal. You didn't have a few days where it was dropping, and you had a little bit a bearish day right here, and then it dropped. That probably explains why it's not running back up again. There wasn't enough fear created in the selling. You'd like to see that near a bottom. Let's look at United Healthcare. Now, you could say, well, is this a hammer formation? Well, it looks kind of like it, but again, you're moving sideways. That's not going to be a very strong signal right there. Take the volume bars off here so we can see here's a little bit of a hammer formation right here. Notice how the next day it opened a little bit in that range. You wouldn't want to, if it drops below the bottom of the hammer formation, it completely wipes out that reversal. There's no reversal momentum there anymore. Could it trade within this area a little bit? Yeah, but again, if this is a reversal, usually that stock's going to get up and go. I will give almost any pattern a pause day because that happens enough times where you just have to be patient sometimes. But if it would have moved sideways and for a second day, I'm probably bailing on that, because again, if there's strong buyers there and there's strong reversal, it should be happening right now. It's not, and if it isn't, then you have to wonder if the buyers aren't strong enough. It's not ready to go up yet, and you might get another move down off of it. So again, this is signaling momentum, and we want to be able to read that momentum, or read if it's strong momentum or weak momentum. All right, let's move on to. Well, I only have a couple hanging man ones to show, so let's look at McDonald's. Not that they don't show up from time, but I wanted to show the ones where it did actually reverse off the hanging man. This one is back in March here. Had this big run up. So it opened up here, it dropped all the way down here. Buyers pushed it back up, but couldn't close it higher. And you see it had a little bit of a drop off that. Again, this is showing just a very short-term weakness here. And you could make the argument that this is maybe just, maybe a little bit of an early warning sign, although this didn't lead to selling, but did lead to indecision where it moved sideways for a few days. Either way, that's not a good, when that shows up, it's usually not a good sign. And then let's look at Honeywell. Here's one right here. Now here's one right here. So like I said, sometimes there'll be like an early warning signal. It still moved higher. You got it again right there, and then that led to a pullback. A little bit of a hammer formation right there, although it opened a little bit lower today. Let's see if it can start taking off of that. All right, so then now let's move over to the other formation. I'm going to start with the shooting star because that's the stronger reversal than the inverted hammer. Let's look at Boeing. Actually, that's not a great one there. Let's look at Goldman Sachs. Here we go. You had this run up, and there's your shooting star. It opened up here, tried to rally again, then faded all the way into the close, closed lower than where it opened, but still higher than the day before. And that was a pretty strong bearish reversal, had a nice little pullback off of that. Here's a little bit of a shooting star. It did lead to a drop, but it was in fact, it came to an intraday low down here. Some of these are going to lead to bigger moves than others, but a lot of times you often get at least a move, in this case, a move down off of it. And that's why sometimes I'll just do real quick overnight trades when I start see these. I'll look at my charts at the end of the market day, right before the market closes, to make sure they're forming the candle, because you could rally up, right at the end of the day, in the last 5 minutes, and this can end up being a doji, where it's just a cross. So usually I'll find a few that I like. I'll wait right till the end of the market day, and then I might trade them. I like to trade them usually with options where I can, if I do just get a real small move, I can get a nice percentage gain out of that small move. Let's look at Home Depot. There's a shooting star. Look at the drop we had right off of that. Now again, the body doesn't, here it closed higher than where it opened, but again, it doesn't have to close lower than where, the ones that close lower than when they open, though, tend to be a little bit of a stronger, to me anyway, it tend to be a little bit of a stronger bearish reversal. But that one had a sharp drop off of that one. That was a nice little shooting star formation there. Coca-Cola. Right there. It tried to open higher right here and then immediately sold off. There's a hammer formation right there. I think we already looked at that one. United Healthcare. There's a shooting star, pulled back. And again, the weaker one would be the inverted hammer. Let's look at a couple examples of that. Let's look at Apple. Right here, here's an inverted hammer. And again, the context here, you'd like to see it drop. Then here it opened lower, rallied up. So the buyers were showing up right here. The sellers managed to push it back down, but it was the buyers were showing some action right there. Not surprising, it bounced a little bit. This is the weaker of the bullish reversals. This would be a weaker bullish reversal. I much prefer a hammer formation. And sometimes these will show up even if and there could still be a little bit further drop. Here's a little bit of a inverted hammer too. Got a little bit of a bounce off of that. This is what we talked about earlier in the week, is the spinning top. Remember, that's just showing indecision. It's not saying there's going to be a bullish reversal. It's just saying there's indecision. Let's do another. Oh, we can do a couple more inverted hammers. Let's look at JP Morgan. Got a little bit of an inverted hammer right there. Got a little bit of a bounce off of it, not much. Let's look at WBA. A little bit of an inverted hammer right there. A little bit of a bounce off of that. All right. So hopefully that helps. Again, if you need to go through this, you can review the recording and start to get it down. But the biggest thing is go out there and you can just pick one stock and go through and see where you can find this type of price action. Just learn to recognize the candle, what it looks like, and then once you get that down, then you can start to see them. They'll start showing up all over the place, and you can start to trade them. All right, thanks, everyone. Have a great week and weekend, and we'll see you on Tuesday for the next market update. Bye now.